the world is going through one of those periods. And by one of those periods, I mean one of those periods where there is a conflict in the Middle East. And when it comes to the United States, it seems like it's been decades since we've last been able to avoid a conflict in the Middle East. And I'm sure, as you've heard by now, there are reports that Trump, along with the United States, is considering joining Israel in striking Iran. Now, the reason for this, I'm sure you already know, is that Israel does not want Iran to have nuclear weapons. Now, Iran says that its nuclear program is peaceful in nature. That's not the point of this video. The point of this video is to make the connection between what's going on there and the likely or possible fallout into the economy, into the finance world. So that's what we're going to focus on here today. If the United States decides to join Israel, either in striking Iran or in a worst case scenario, actually joining the conflict long term, and this spills into a global conflict, either with the United States, Europe, something that is protracted. What happens to the economy? Well, I'm going to give you my best presumptions based on data. So with that said, as always, my name's Derek. I got my degree in finance. You don't have to. Let's get right into it. Okay, first, let's set the stage. So if the United States is going to join this conflict between Israel and Iran, it's going to join on the side of Israel, obviously. I mean, regardless of how you or I feel or don't feel about Israel, Israel and the United States are allies. And one of the main reasons that's being contemplated, in fact, Donald Trump gave a timeline of 2 weeks to figure out whether he's going to move forward with strikes or not. One of the main reasons is the Fordow nuclear facility in Iran. This facility is it's basically in a mountain. It's very fortified, and Israel cannot reach and destroy this facility. Now, the United States, being the military-industrial complex that the United States is, can. The United States has 30,000-pound bunker-busting bombs. These are known as MOPs, or massive ordnance penetrators. These theoretically can reach and destroy this facility. So if the United States is going to join, that is the likely first target. Now, with that said, a strike is just, or could be just, the beginning. The other outcome or potential outcome is that this turns into a regional conflict, either with military boots on the ground or at least military aid when it comes to intelligence, munitions, etc. So those are the two main outcomes, either a limited strike, 1 or 2 targets, or a much larger involvement. So we have to look at the economy through both of those lenses. Now, regardless of which of those two actually ends up happening, the first initial strikes are going to happen in either scenario. And that means very short-term repercussions for primarily the stock market and the oil market, which means gasoline prices. So anytime a war starts, the stock market usually, when you look at previous data, moves down. It could move down 1 to 3%. If investors feel like this could turn into a larger thing, it could move down more, 4 or 5%. With that said, when it comes to the stock market, if you are invested in the stock market, if you are doing your part properly, which means if you're younger, you have a larger portion of your money in the stock market. If you're middle-aged or older, you should have started to move some of that out into assets like bonds, right? Safer haven assets. So regardless, after war begins, usually the stock market recovers, and it recovers relatively quickly. And then a lot of times during a protracted conflict, the markets do well. So if you are invested in the stock market in any capacity, you probably don't want to move your money. Unless you are very, very close to retirement, you probably just want to let this happen and ride it out, okay? Because if we're talking about 3, 4, 5, 10 years, you are basically at zero risk from this regional conflict. Now, if you're on the other side, if you're an active investor bordering on a swing trader, there might be some plays here. Now, the obvious ones are obviously defense, right? The problem with defense is, remember, the market is forward-looking, so that's probably already priced in. So when it comes to the stock market, you can expect, if the U.S. strikes Iran, you can expect a dip, okay? And then you can expect an immediate rebound of the market. Now, when it comes to the oil market, remember, this region is ripe with oil, and the world runs on oil, okay? So any disruption to the oil supply is going to have negative effects on certain industries and positive effects on other industries. Now, the major negative effect would be on gas prices, because if the oil supply is threatened, that means the price per barrel of oil is going to increase. Now, if we get like basically the major point here would be the Strait of Hormuz. This is basically where about 20% of global daily oil passes through. So any sort of disruption in this strait, it's considered the most important strait or passing for oil on the planet, because 1/5 of the global oil passes through this strait. So any sort of blockade or attempt or any sort of violence in this area, now we're talking oil prices could shoot up to, we've seen it before, but 110, 120, even more, $130 per barrel of oil. Okay. Now, the good news here is that the United States has significant military and naval assets in this area, so that a full blockade by Iran is not possible, basically, and it's very unlikely. With that said, Iran can do something else. It can just cause violence here, right? It can do guerrilla tactic type style of attacks. It can just disrupt the oil flow here. If that happens, you're going to see panic in the global equities market, and you're also going to see oil prices shoot up, okay? Because people trade oil, and they're going to trade it on that. If that happens, you might see a spike in gasoline prices. But this is where we start to talk about the more long-term effects, because if you just see a strike, and you don't really see retaliation from Iran, or you see minimal retaliation from Iran, then this whole thing will be done and over in 7 days, maybe 14 days. If instead you see a protracted conflict where the United States is now sharing intelligence, sharing munitions, and potentially even joining Israel in striking Iran, when we're talking for multiple weeks or months, or this turns into a literal ground war between Israel and Iran, well, then now the ramifications for the economy move further out, okay? Because now we're talking about potential inflation risk through energy prices, which means we have to bring in the Federal Reserve into this conversation, which means we have to bring in interest rates into this conversation, which means we also have to bring in the prices of everyday goods, okay? So if this turns into a protracted war, the Federal Reserve, which is already hesitant in lowering their interest rates because of the threat of tariffs when it comes to inflation, they just had a meeting, they did not lower their FFR, precisely because they're worried about tariffs, they're going to be even more hesitant. Why? Well, because in a global conflict or a regional conflict that affects the globe, you have the chance of increased inflation through energy prices. Now, obviously, you might say, well, Derek, the Federal Reserve cares mostly about PCE core inflation. That's the personal consumption expenditures core inflation. That doesn't take energy prices into account, right? That removes volatile assets. That is true. But the rest of that basket is also going to be affected by energy prices if they increase, because your shipping costs go up, right? Your production costs go up, right? Panic buying might take effect. So all those things affect the prices of the rest of the PCE basket, and definitely the CPI, which is the Consumer Price Index basket. So even though the Federal Reserve doesn't technically look at PCE, they care about core PCE, it's still going to be affected. And whether they say it or not, the Federal Reserve does take energy prices into account when they're making their decisions when it comes to cutting interest rates. So that means you would have higher interest rates for longer. You might also experience very real inflation at the gas pump, of course, but also when it comes to food, when it comes to clothing, when it comes to electronics, because all these things are shipped. Okay? And we are not living in a day and age where our shipping runs on solar power, right? They still run on very real fuel sources, fossil fuel sources. So if you have an increase in the oil prices, you're going to have an increase in shipping. And if you have an increase in shipping, you're going to have an increase in inflation here stateside. Okay, those are the negative effects. Are there any positive effects? No. I mean, not to mention the tragic loss of life that will happen, that's already happening, and that will continue to happen. The only positives could be that if you're invested in the proper stocks, right? Or if you're divested in the wrong stocks. So obviously the stocks that are going to do well are defense. Now, again, this is already priced in. So at least a short-term conflict is already priced in. So if it spirals into a long-term conflict, then yes, your defense stocks are going to continue to do well. Another thing that will do well is the U.S. bond market, because you're going to have investors running to safe haven assets. That's investors domestically as well as abroad. When wars happen, bonds do well because investors want safe haven assets. And in war, U.S. bonds do pretty well because the United States is still, even with all the turmoil and craziness that's going on with Trump and tariffs, it is still considered a safe haven. So if you're invested in bonds, that will likely do well. Or if you trade bonds, that will likely do well. Now, some of the stocks or areas that would suffer are you're going to have, for example, airlines. I mean, airlines are going to suffer, not just because they might have to divert routes. That's the minimal part. But the major one is fuel costs. When you look at airlines, I mean, they are razor thin when it comes to their margin. And I know when you go and you buy a ticket, you say, this ticket is $500. How are the airlines barely getting by? It is an expensive business model. Airlines they're not profit-making machines like tech. They're running on razor-thin margins. So if you have an increase in fuel costs, that means they're already thin margins. You get margin compression. You also get that passed on to the consumer because they literally can't fly unless they raise ticket prices. So you will get increased ticket prices, which is going to lower demand. So airlines are not going to do well. And of course, if airlines don't do well, that also means that tourism, any sort of tourism industry is also not going to do well. Cruise lines are not going to do well. And tech, believe it or not, tech tends to be very, very sensitive to volatility. So when you have an increase in volatility, you have an increase in the VIX, Fear and Greed Index. I mean, you're going to have, you're most likely going to see negative effects in tech. And one other last area that I want to touch on are emerging markets. I mean, emerging markets are also extremely sensitive to volatility in the globe because they are not as stable as markets like Europe or the United States or Asia, or at least the more developed markets in Asia. So very much new or developing markets or any sort of index fund that tracks these might suffer as well. Now, on the flip side, another area that will do well, likely, is of course energy, especially domestic production energy. So that means energy companies in the United States, they're going to do well. And here's the thing. When you compare the United States to Europe, Europe tends to be very energy dependent to this Middle East region, which means that also, and I should have mentioned this when I was talking about U.S. bonds, European bonds might not do as well because a lot of those bonds are energy dependent, and that energy is usually imported. Whereas the United States, you have a lot of domestic production here, so energy companies here might actually do well. So without risking making this video way too long and dragged out, you basically have a ton of negative effects with a few positives if you are invested in the right areas. And this is in either scenario. If it is a short-term, couple-week involvement with the United States, well, then you're going to have some of those initial effects. You're going to have a down stock market, which is going to recover. You're going to see potentially a spike in oil prices and maybe a spike of 25 to 50 cents when it comes to gasoline prices, but that will be limited. If instead the United States joins this conflict on a protracted basis, I mean, we're there for months, then you're going to have spillover where you're going to have to bring in the Federal Reserve into this debate. You're going to have to bring in inflation into this debate. You're going to have to bring in airlines, cruises. You're going to have to bring in shipping costs. And really, the major threat is, again, inflation, which is not a very good place to be right now because it raises the risk of stagflation. So short term, you have minimal just pain, basically. And then if we're there long term, you have basically the overarching subject of this video would be stagflation. You have an increased risk of stagflation because once again, you have the same economy, but you have increasing inflation due to energy prices and a ripple effect through other industries that rely heavily on energy prices. So I hope this video was informative. We'll have to wait and see what happens. Hopefully by the time I release this video, there has not been a strike, but it seems like it's on the table. So we'll have to wait and see what Trump decides to do. and we'll have to wait and see if this is a very short-term military action or if it turns into snowballs into some regional conflict that nobody likes. If this video was informative, please consider subscribing. It helps the channel out tremendously. And if you like personal finance, world economics, and investing, and sometimes geopolitics, things that relate to the economic world, then you're in the right place. So I hope to see you in the next video. With that said, I hope you have a fantastic rest of your day, and I will see you in the next one. Take care.